Jensen Huang just dropped a bombshell that should make every serious investor sit up straight. The AI shift isn't slowing down. It's accelerating into a multi-trillion-dollar transformation, and according to the man who built the most valuable chip company on the planet, the real opportunity is only now beginning. While the market debates whether AI is overhyped, Nvidia's CEO is effectively saying the infrastructure build-out ahead could reshape entire industries. I'm going all in on 3 stocks positioned right at the center of this wave. Stick with me, because the latest 2026 numbers change the story completely. Here's the bigger picture. Artificial intelligence is no longer just about training giant models in a few hyperscale data centers. We're moving into the inference era where AI runs continuously at scale across enterprises, robotics, agentic systems, and real-time applications. That shift demands more compute, more specialized silicon, more advanced packaging, more design software, and far more power-efficient cloud infrastructure than most people realize. Huang has repeatedly framed the opportunity in the trillions. Recent commentary points to multi-trillion-dollar data center and AI infrastructure spending trajectories through the end of the decade. Whether the precise figure lands at 3, 4, or 6 trillion over time, the direction is clear. The capital intensity of AI is rising, not falling. The winners will be the companies that supply the picks and shovels chips, foundry capacity, design tools, and purpose-built AI cloud platforms at the exact moment demand is exploding. Most investors still chase pure GPU names. Smart money is looking 1 and 2 layers deeper. Stock number 1. Intel, INTC, the unexpected comeback. Intel was written off by many. High costs, process delays, and fierce competition from TSMC and Nvidia painted a bleak picture. Then the numbers started turning. In the second quarter of 2026, Intel reported revenue of $16.1 billion, up 25% year-over-year, its strongest growth rate in more than 15 years. Non-GAAP earnings per share came in at 42 cents, crushing the consensus of around 21 cents. Gross margin expanded dramatically to 41.8% on a non-GAAP basis. Data center and AI revenue hit $6.3 billion, surging 59% year-over-year. Client computing also grew solidly. CEO Lip-Bu Tan highlighted that AI-driven businesses now contribute roughly 70% of revenue and grew more than 70% year-over-year. The company is ramping Intel 18A, pushing advanced packaging, and expanding foundry capacity. Guidance for the third quarter calls for revenue between $15.8 billion and $16.8 billion, with non-GAAP EPS of 38 cents again above prior expectations. The market initially sold the news, which is classic when a long-suffering stock finally delivers. But the fundamentals are shifting. Intel is no longer just a PC company. It is building a credible AI infrastructure story around Xeon processors, custom silicon, advanced packaging, and foundry services that hyperscalers and enterprises actually need. When the AI build-out requires more than pure GPUs, think CPUs for orchestration, high-bandwidth memory integration, and secure enterprise inference, Intel suddenly looks relevant again. The turnaround is real, and the valuation still reflects skepticism. That gap is where opportunity lives. While Intel rebuilds the silicon foundation, another company is monetizing the purest form of AI demand right now: raw, high-performance compute capacity delivered as a service. That company is CoreWeave. Stock number 2, CoreWeave, CRWV, the AI cloud pure play. CoreWeave is the essential cloud for AI. Unlike general-purpose hyperscalers, it was purpose-built for GPU-heavy training and inference workloads. The first quarter 2026 results were staggering. Revenue reached $2.078 billion, more than doubling year-over-year. Adjusted EBITDA hit $1.157 billion with a 56% margin. The real jaw-dropper was the revenue backlog, nearly $100 billion as of March 31, 2026. The company has surpassed 1 GW of active power and is targeting more than 8 GW by 2030. New multi-year deals with Meta, Anthropic, and expanded relationships with Cohere, Mistral, Jane Street, and others show that both AI labs and enterprises are locking in capacity for years. CoreWeave is moving aggressively into inference with dedicated offerings, flexible capacity plans, and Nvidia exemplar cloud status for GB200 systems. Nvidia itself invested $2 billion in CoreWeave stock, a powerful vote of confidence. Yes, the company is still reporting GAAP losses as it invests heavily in growth and carries interest expense from its capital-intensive model. But when backlog approaches $100 billion and utilization remains high, the path to scale becomes clearer. In an AI world where training runs are massive and inference demand is continuous, the specialized cloud providers with the best utilization, software stack, and power access will capture outsized economics. CoreWeave sits squarely in that lane. Chips and cloud capacity mean nothing without the tools to design the next generation of silicon. That brings us to the quiet powerhouse of the AI supply chain, Synopsys. Stock number 3, Synopsys, SNPS. The design monopoly. Every advanced AI chip, whether from Nvidia, AMD, custom ASIC teams at Google or Amazon, or Intel's foundry customers, runs through electronic design automation software. Synopsys is the leader. In the second quarter of fiscal 2026, Synopsys delivered revenue of $276 billion, up more than 40% year-over-year and above guidance. Non-GAAP earnings per share came in at $3.35, beating expectations. The company raised full-year fiscal 2026 revenue guidance to roughly $9.625–9.705 billion and non-GAAP EPS guidance to $14.72–14.80. Free cash flow is expected near $2 billion. The AI boom is directly fueling demand for more complex designs, larger system-on-chips, advanced packaging verification, and AI-assisted design tools themselves. Synopsys is also integrating AI into its own software tools that help engineers design better chips faster. That creates a virtuous cycle. More AI demand requires better chips, which require more Synopsys software, which enables even more capable AI systems. High valuations are the perennial concern with Synopsys. Yet the combination of pricing power, recurring revenue characteristics, and structural growth tied to semiconductor complexity makes it one of the highest quality compounders in the entire AI ecosystem. When Jensen Huang talks about the scale of the opportunity, every extra layer of silicon complexity flows through companies like Synopsys. So let's bring it together. Jensen Huang is telling us the AI infrastructure cycle is still in its early innings. The shift from training to widespread inference, agentic systems, and physical AI will require unprecedented amounts of compute, specialized silicon, foundry capacity, and design tools. Intel is proving it can grow again and capture AI-driven demand across CPUs, packaging, and foundry. CoreWeave is locking in multi-year, multi-billion-dollar commitments as the pure-play AI cloud of choice. Synopsys sits at the design layer that every advanced chip must pass through, with financials that keep accelerating. These are not risk-free bets. Intel still has execution risk. CoreWeave carries high capital intensity and valuation sensitivity. Synopsys trades at a premium, but the direction of travel is unmistakable. The companies enabling the trillion-dollar AI infrastructure build-out are not sitting still, and neither should serious investors. I'm positioning for the long game here. The $6 trillion shift Huang is pointing toward doesn't happen overnight, but the leaders of that shift are already printing numbers that demand attention. Do your own work, size positions responsibly, and stay focused on the real enablers rather than the hype cycle. If this breakdown helped you see the opportunity more clearly, hit that like button, subscribe, and drop a comment with the stock you're most bullish on. The next phase of AI investing is just getting started. Let's build the future together.